Venu, hi, morning. Good to have you on the show. I think the big headline today, as was the case for the last fortnight, has been the spike in India VIX. I mean, what's leading to this heightened volatility? Why so much nervousness? Is it just pre-election, typical as that, or is there something more to it?
Yeah, thanks a lot, for having me on the show. Yes, we've actually seen a lot of nervousness that has been emerging, especially this month, and a part of that is driven by broader concerns around how the voter turnout was in the initial three phases, which is leading to worry on the overall extent of the win that the current ruling government would have. Now, the reality is that just about a few weeks back, when the phase one was about to start, I remember one of the reports we had written about the fact that 400 plus was already getting priced in, given the euphoria we had seen the few weeks prior to that phase one commencing. Is to an extent played out when the predictions sort of started to change about what could be the eventual outcome. So what you see right now has nothing to do with what will eventually happen. We do still believe there's going to be continuity of power, but it's more about the extent of win, which is sort of playing in terms of concern, and that's where you're seeing volatility. That's one part of the story. The second part, very quickly, is the fact that look, this earning season has been also lacking a spark, which is another thing we've been talking about. It's not that this is a bad earnings season, but it's not like going to lead to any upgrades to earnings growth estimates across the board. So that's another aspect which is sort of keeping, sort of yo-yoing the markets in some way and keeping some of the expectations in check.
Why are FIs selling the way they are selling? Is it anything to do with the election preparedness, or this is money moving out from India to other emerging markets?
Yeah, so interestingly, I've had some 150 plus meetings, okay, and it's spread across various countries that I was traveling for the last few weeks. And interestingly, my thinking was that FIIs, while they really like India as a potential asset class, a sustainable asset class over the long term, they were particularly worried about the valuations and the valuations that India had in terms of a gap with some of the other emerging market countries, especially China. Now, having said that, what it means is primarily that the willingness to incrementally add was relatively lower. I didn't really hear basically a thinking that they would be dumping stocks in the market, but the willingness to buy was relatively lower in the near term. And the second aspect is there was a lot of questioning around elections. So I do believe that there's some degree of sort of risk measures which are being taken in case of a different outcome than expected. Doesn't mean that they have any view on the outcome. That's the second part of the story, and I think you've really seen China also do well. But my fundamental belief is taking out money from India doesn't mean it really is large enough to move other markets. So I don't think I would call India money being taken out to push through other agendas at this juncture.
So at the current juncture of 22,000 on the Nifty and about 50,000 on the small and the mid cap index, the Nifty mid cap index, what do you think markets are pricing in from an election cycle? I mean, what exactly is in the price and what is not in the price?
Yeah, so this is a very important question because of late in the last 1 week, I have been asked this question multiple times by quite a few investors, and I realize that I can't give very rational answers to this, but I'll give you a qualitative answer, which broadly is based on conversations rather than anything else. See, a change of a government, which is in fact a low probability event, as we know, is definitely not priced in. If there's going to be a change of government, there's going to be a massive correction in the equity markets, with SMIDs, of course, seeing more correction than the large caps. Uh, Beginning of this, probably this quarter or this month, I felt that when the markets were closer to 23K, was probably pricing in 400. In terms of win or a massive mandate, two-third majority and above. While at this juncture where we are, I'll probably say that a win is definitely priced in for sure, but probably in the 330, 350 range. So it's that range which is getting priced in at this juncture, which is more or less something which they achieved in the previous election phase as well. This is the way I would characterize it. But remember, there is no math behind it. It is basically based on conversations across the board and generally trying to gather expectations.
Now, I'm spending a lot of time on this because that is in the moot point. Research and results and technicals for the moment for next 2 or 3 weeks is perhaps on the back burner. Scenario number one, which is a month ago or 2 months ago, markets were pricing in a 400 kind of a number for the NDA government. Now, like you said, markets are pricing in 320 to 350 kind of a number. What are the chances that if the current government comes back, but the number is just above the 51% mark, just closer to 280, 290, will that have an impact on the market, or that does not matter? As long as the current government comes back in full majority, it could be a weak majority, it could be a strong majority, markets unlikely to move?
See, the way I would present this is that I do believe that if we're closer to just above the majority mark for NDA, okay, as an overall entity, that's not good for the markets in the near term. So you would probably see, a small correction, which would probably last for a while, before which people start to accept the reality that end of the day, there's continuity of power. So in that sense, a lot of economic growth agendas of the current government are going to be continuing without any policy disruptions. So markets will come back. So eventually, after comeback doesn't mean you spike up back and generate a 30% return this year, but it comes back up to where we probably started with. So think of an order of correction of maybe 5, 6%, 7%, ballpark over a period of time if that scenario plays out. So that's the way I would probably highlight as to what that outcome could be. Remember, there are these 100-day agendas of the current government that they are planning to do after elections. There'll be a budget as well. A lot of these pent-up orders will also come back. So there is a lot of events which could be created post-elections to ensure that you don't really see too much of a sustainable downside as well.
Okay, since we've talked about the event quite a bit, let's bring it back to fundamentals, because after that June 4th date, it'll all be back to that. And as you talked about that 100-day agenda and budget, those will be the next talking points. But Venugopal, you talked about how overall this earnings season has been a bit muted, lacking the spark, as you said. But after that, have you made any, big changes in terms of your recommendations in terms of the overweight, underweight? Because I do see that you've added perhaps Zomato and ICICI Bank recently to your model portfolio. Anything else?
Yeah, you're right. We've been a bit sleepy around changes because the market also has been sleepy. So it sort of matches with that viewpoint. Primarily, we wanted to add a bit more to financials, and hence ICICI Bank, which used to be a part of a portfolio earlier for more than 2 years, 2.5 years, which was taken out for a few quarters, has been reinserted to basically bolster the financial sector positions. And more importantly, we have 3 stocks out in financials at this juncture, all 3 private banks. Zomato is a risk sort of a trade, in the sense that after having been a part of Zomato story for the entire last year, having seen a doubling of stock price, we had sort of, as a portfolio, taken profit beginning of the year, and it's been a pretty bold thing to get back in, at 180. And a part of that is primarily with the thesis that this is not really going to be impacted too much with what happens to the domestic macro story or election. This is primarily a very different story, which is more linked to grocery and how that sort of builds up in terms of a model. And near-term momentum was also fairly strong. So if you think about it, one was more a sector bolstering call. The other was more a bottom of stock return call, but playing near-term momentum on that. Otherwise, no major changes at this juncture to our overall stock positioning, which is more large cap oriented. And of course, with financial sector being the key overweight.
Let's look at the possibilities purely in terms of what could happen. One is there is a bond inclusion which will start kicking in from June. Second is that by June end, you pretty much know that which way markets would have settled in terms of the election verdict. We would know which way the monsoon has also moved out. So as you look into the future, do you see that the second half being constructively very different for India? Because bond flows will start, clarity on monsoon would emerge, and the market adjustment to the election cycle, whether it's good, bad or ugly, that hopefully would settle by June end.
No, that is a very fair commentary. Look, a lot of uncertainties will go away in the second half. That's the simpler way to represent it, right? Global uncertainty around rates, probably it's not very clear as to how that shapes up. Bond event is fairly well known, so I don't think it's going to come as a surprise to the markets. It's more about uncertainty around the eventual ruling government, uncertainty around policies go away. and visibility on monsoons will come through. We still don't know what might happen around there, but we'll have an idea after probably June, July timeframe. So those are things which are, of course, soothing for the markets. Nifty being flat year to date, roughly flat, right? Dollar terms, probably it's flat at this juncture. We have an 8% return expectations in INR terms. So that really calls for some positive returns in the second half. So that's the way it's been modeled to a large extent.
The other thing I wanted to understand is from the earnings so far, where is it that you're getting a little cautious going by the management commentaries? Because, many companies out there, you thought they're going to deliver something and they've clearly failed to meet street estimates. And of course, which are the pockets that you would continue to avoid? Is IT falling in there?
Yeah, I mean, look, honestly, the simpler way to look at this was sectors which actually did well last year are sort of cautioning relatively mixed growth outlook, like autos, for example. Last year, strong growth, and even the previous year was strong growth. So that's one area where there's more of a mixed outlook. Consumer in general, we're not really seeing any gung-ho outlook at this juncture. There is a very mixed view on rural. In any case, volume growths have been fairly weak on the staples front in general. So nothing much changing out there in terms of positivity for us at this juncture. In the IT sector space, I guess, the fact that the commentary remains weak is, an aspect which probably was anticipated beginning of the year, but this is not going to lead to any major changes in outlook, given that people were generally very negative. But yes, even this sector, which was weak last year, is not really seeing any recovery this year, right? So same is the case with consumer staples. So what appears at still okay and steady AD is probably financials, which had a decent growth last year. It's not really deviating in terms of growth. You've had a couple of really good numbers from financial sector frontline stocks, including some of the SOVs. So if I were to think about it, my nervousness would be more with the consumer pack in general across the board, given that valuations are also not very supportive. And the rest of the pack, I think it's fairly, either priced in or fairly okay, I would probably say. Two sectors which I excluded were industrials and utilities, which the drivers are very different there. Valuations are relatively excessive, and hence we just generally look at some specific stocks here and there in terms of bottom-up opportunities. But otherwise, if you think about it, even frontline stocks, they were either issues on margins or in general about worries around government capex slowdown. But that's a space where still positive over a 3-year view, given the cycle outlook.
Okay, Venugopal, on that note, we let you go. Appreciate you making time and speaking with us today.
If you like this video, then like, share and subscribe to ET Now.